If the central bank starts creating money again before inflation is truly dead, then you are no longer watching a rescue. You are watching a rationing system. That is the first thing I would tell you. The second thing is harsher. Most people still think money printing is a technical event that happens somewhere far above their lives, in conference rooms, in legal language, in spreadsheets so abstract that it feels almost impolite to translate them into ordinary human terms. I do not see it that way. I see it as a transfer system. A transfer from savers to borrowers, a transfer from future purchasing power to present political comfort. A transfer from anyone living on wages, cash, pensions, and fixed promises toward the debt structure that the country can no longer carry. Honestly, that is what the Federal Reserve is doing when it expands its balance sheet into a world where inflation is still breathing. And that is why I do not hear reserve management or technical operations or any of the other soft phrases institutions use when they want the public to look at the curtain instead of the engine. I hear one thing: the system is out of good choices. That is the real story. The Fed is not standing over a healthy economy making elegant adjustments. It is standing inside a burning building deciding which room gets flooded first. That is different. And once you understand that difference, gold stops being a side opinion, inflation stops being a headline, and the bond market stops being some distant professional arena reserved for economists. It all becomes one machine. One machine with too much debt, too little honest demand for that debt, too much political need for easier money, and too little room to restore stability without harming something larger than the institution is willing to admit. I have spent enough of my life watching markets to know that the public usually recognizes the danger at exactly the wrong layer. It looks at prices on a screen. It looks at the interest rate decision. It looks at whether the Fed cut, paused, or hiked. That is how children watch monetary policy. Adults watch the constraint. What would the institution do if it were truly free? That is the question. If inflation were calm, if debt were modest, if bond buyers were eager, if private credit were healthy, if housing were affordable, if commercial real estate were not begging for mercy, if the labor market were not softening, if oil were not pressing on the whole system from above, what would the Fed do? That question matters because it tells you what the institution wants, and what the institution actually does tells you what the structure permits. Right now, the gap between want and permission is the whole story. The Federal Reserve would like to avoid another inflation cycle. It would also like to avoid detonating the debt structure, the private credit structure, the banking structure, the Treasury refinancing structure, and the housing structure. It cannot fully protect both sides anymore. That is why I say this is not a normal policy environment. It is a damage allocation regime. A damage allocation regime always sounds civilized when described by officials. It is not civilized when experienced by savers. Savers feel it through rent, food, gasoline, insurance, medical costs, car repairs, and the strange humiliation of watching a bank balance stay visually intact while its real buying power quietly drains away. That is the tax. Not voted on directly, not introduced honestly, but levied all the same. I want you to think about the dollar system as a dam built across a river of debt. For years, the dam held. Cheap money came through. Bond buyers kept showing up. Foreign demand stayed strong enough. Rates stayed manageable enough. Asset prices floated high enough. Every weak structure under the surface was forgiven because liquidity was plentiful, and the cost of carrying leverage stayed low enough that weakness could keep pretending to be sophistication. Then something changed. The river got too large. Debt piled up faster than productive capacity. The Treasury kept issuing. The private sector kept refinancing. The banking system kept carrying underwater exposures. Commercial real estate kept depending on rates that no longer exist. Private credit kept pretending the exit door was wider than it really is. And above all of it, the Federal Reserve kept needing the river to stay calm enough that the dam would not crack visibly. That is where we are now. The official story is that the system is being managed. My reading is simpler. The dam is being patched while the water pressure rises. That is why I think the balance sheet expansion matters so much. Not because the public understands central bank accounting, because central bank accounting is where institutions confess what they cannot yet say in speeches. When the balance sheet expands, the truth is this: money is being created to absorb paper. The system is struggling to absorb honestly. You can wrap that in a nicer sentence if you want. I do not see the use. If the central bank is buying more treasury bills because the market cannot or will not absorb enough at the old terms, then the state is being financed through synthetic demand. That is the beginning of the whole moral rot. It means the price of state borrowing is no longer being discovered purely through natural discipline. It is being managed through monetary intrusion. Once that begins, the market starts asking a question it always asks eventually. If the state must increasingly be funded by its own central bank, what exactly remains of the discipline supposedly protecting the currency? That is the right question, and gold hears that question before most people do. I want to explain the structure beneath this in plain. The first mechanism is what I call the Treasury appetite problem. The United States issues debt because it must. That is not a theory anymore. It is daily plumbing. The government runs deficits large enough that continuous borrowing is not a policy choice, but a survival mechanism, that debt must be placed somewhere. Traditionally, the market absorbed it through a combination of domestic institutions, foreign reserve managers, pension structures, banks, funds, and a very large background assumption that treasuries were the obvious place to park serious money. That background assumption is what made the whole system feel elegant. If enough outside capital wants the debt, yields stay manageable. If yields stay manageable, the state can keep borrowing. If the state can keep borrowing cheaply, the political class can postpone harder decisions. The issue today is that the market's appetite is no longer as effortless as the debt burden requires. The debt is too large, the refinancing wall is too constant, the fiscal picture is too weak, and inflation has proven too alive for the central bank to behave as though it can simply cut and let the problem melt away. That is why the Fed's buying matters. Not because buying short paper under a nicer label sounds exotic, because it tells you something simple. Natural demand is not sufficient at comfortable prices, and once natural demand is not sufficient, every future issuance takes place under a darker sky. The second mechanism is the inflation constraint paradox. Most ordinary people think the Fed should simply cut rates and relieve pressure. That instinct comes from earlier cycles. When growth weakened and inflation was calm enough, the central bank could lower the cost of money and reflate the room. Fine. That playbook only works when inflation is weak enough that easier policy does not immediately risk reigniting the very problem you claim to be curing. This is why the environment is so poisonous. Now the inflation is not dead enough for honest ease. Oil is too high. Supply pressures are too present. Housing costs are too sticky. Services inflation is too persistent. And the public is already too sensitive to price pain. At the same time, the economy is not strong enough to endure prolonged real discipline without stress surfacing elsewhere. Private credit wants relief. Commercial real estate wants relief. Banks with ugly securities books want relief. The Treasury wants relief. The housing market wants relief. The indebted consumer wants relief. Everybody wants easier money. But easier money in an inflationary environment does not feel like relief for long. It feels like betrayal. That is the paradox. The more the system needs easier policy, the less honest room there is to provide it cleanly. That is when institutions begin using softer routes, a little here, a little there, more balance sheet support in technical language, more reserve management, more short-end assistance, more operations whose real purpose is to keep the machine running without publicly admitting how dependent the machine has become. That is what Phase 2 looks like. The third mechanism is the bond market lie detector. Stocks can stay romantic for a long time. The bond market is colder. The bond market has less patience for narrative because it is not being paid for mood, it is being paid for math. When longer yields rise in a world where the central bank would dearly prefer easier conditions, the market is not merely being noisy. It is testifying. It is saying that the compensation demanded for holding long promises in dollars is rising because trust in the future path of rates, inflation, and fiscal discipline is weakening. That matters enormously. Because the 10-year and 30-year yields are not decoration. They are the reference points against which mortgages, business borrowing, real estate cap rates, refinancing costs, and asset valuations all reinterpret themselves. When those yields misbehave, the whole economic body starts receiving bad signals. Housing becomes less affordable. Private markets become harder to clear. Refinancing math gets uglier. Speculative growth narratives become more fragile. The Treasury itself faces a higher carrying cost on new issuance. This is why I say the Fed is not just trapped by inflation. It is trapped by the bond market's refusal to to cooperate with the fantasy that debt this large can remain painless forever. The fourth mechanism is the debt service transfer. This may be the single most underappreciated issue in the whole picture. People hear the national debt number and let it become political theater. That is a mistake. I prefer a simpler question. How much real economic energy must now be transferred every year, simply to carry yesterday's promises? Once you ask that, everything gets uglier. Interest expense becomes one of the largest line items in the national structure. Not productive investment, not growth, not renewal carrying cost. When a state spends more and more of its fiscal capacity on interest, it begins resembling an indebted household that uses most of its paycheck to service old commitments, while telling itself it still has a normal future. That household usually does not end well. At the national level, the consequences are slower but not kinder. Crowding out rises. Political stress rises. The temptation to reduce the real value of the debt through inflation tolerance rises. This is why I say money printing is not just an accounting act, it is a political transfer. If the state cannot bear the true market price of its own borrowing, and the central bank steps in to absorb more of the burden, then someone else pays. And the someone else is usually the saver, the wage earner, the fixed income retiree, the person holding cash, the person believing a nominal promise still means what it used to mean, that is, who pays. Quietly, monthly, without a vote. The fifth mechanism is the label fraud. Institutions love language because language buys time. If they buy long bonds with printed money, that sounds too much like the old phrase the public learned to fear. So they change the label. If they support the short end instead, perhaps it becomes reserve management. If they offset one category while growing another, perhaps the headline can remain calm enough that the word printing sounds too impolite to use. Fine, I understand the function of language. I simply do not let it fool me. If balance sheet expansion is occurring while inflation risk remains elevated, the action remains inflationary in direction whether or not the phrasing is elegant enough to satisfy the public relations department. That is what matters. The money exists. The paper is absorbed. The state is funded. The system buys time. The purchasing power burden shifts elsewhere. I do not care what they call it. The sixth mechanism is what I call the gold readout. Gold is not a mood ring for panicked people. That is a childish way to look at it. Gold is a readout on trust, restraint, and institutional freedom. The freer the central bank is to defend the unit. Honestly, the less urgent gold's function becomes. The more trapped the central bank becomes between inflation, debt, growth weakness, refinancing stress, and political succession pressure, the more gold begins behaving like a warning light. That is why I think most commentary about gold is still too shallow. It treats gold as if it were making a one-dimensional statement about inflation. Gold is making a higher order statement. It is saying the institution in charge of the currency is losing clean room. That is different. And it matters because once the market begins pricing lost room, it is no longer waiting for official admission. It is front-running the eventual behavior. That is phase 2. The quiet buyers in phase 1 were positioning because they understood the direction. The buyers in phase 2 are positioning because the trap is now visible enough that direction has become structure. That is when the move gets larger. Gold rises first because it is the purest readout, silver lags, fidgets, and then often overreacts later because silver carries both monetary and industrial DNA. Miners look lazy until margins suddenly matter more than the public had respected. That is the normal progression. People think they are waiting for confirmation. Usually they are waiting to overpay. The seventh mechanism is the succession risk premium. This may sound political, but it is really institutional. When the next leader of a central bank is uncertain, or when the market believes political pressure on the leadership transition could increase the probability of easier doctrine later, every present decision is interpreted differently. A hold stops looking like conviction. It starts looking like delay. A pause stops looking like confidence. It starts looking like a bridge toward a softer successor environment. This matters because institutions live. If the market expects the future chair to be more accommodative, more politically permeable, or simply more willing to tolerate inflation in order to protect growth and debt sustainability, then gold does not need to wait for the appointment to be finalized. It can price the drift in advance. That is another reason I say phase 2 is here. A trapped institution plus visible succession uncertainty is exactly the kind of combination that turns latent distrust into active repricing. The eighth mechanism is the real asset repricing loop. Once money creation becomes the inevitable answer to a debt structure that cannot withstand honest rates, the rational question is no longer whether nominal prices will rise. Of course, many nominal prices will rise. The real question is which forms of wealth can stand outside the dilution path and which remain trapped inside it. This is where ordinary savers get hurt. They keep their cash where it feels safe. They hold long bonds because the label still sounds civilized. They trust retirement statements denominated in the unit that is under slow pressure. They admire nominal gains without comparing them to the shrinking buying power underneath. Meanwhile, real assets, scarce assets, productive assets with pricing power, and monetary alternatives begin repricing against the weakening honesty of the unit itself. That is not a gold-only story. It is an architecture story. The dollar does not have to collapse theatrically for this to matter. It only has to lose freedom at the margin while the central bank becomes increasingly unable to protect the unit without detonating the debt structure. That is enough. That is how savers get poorer while numbers on their statements still look respectable. Now, I want to say something about ordinary people, because too many macro discussions are delivered as if households are just statistical scenery. They are not. They are the real victims of late-cycle monetary cowardice. A man holding cash for an emergency is not running a policy experiment. A retiree holding bond funds is not making a grand historical bet on the final years of debt monetization. A family with savings in ordinary accounts is not choosing to subsidize the refinancing burden of the sovereign. Yet that is often what happens. When the central bank buys time for the system, it usually does so by making honesty more expensive and dilution more acceptable. The saver becomes the shock absorber. The wage earner becomes the absorber. The pensioner becomes the absorber. That is why I react so badly to the calm language officials use when discussing these trade-offs. They speak in terms of financial conditions. Real people experience it as a narrower grocery cart, a weaker savings account, a thinner retirement, a delayed house purchase, or a life that somehow feels more expensive even though nothing visibly collapsed. That is how the system taxes them, quietly, continuously. Now, I do not want to leave this in the abstract. If I were writing the operating system for a serious saver in this environment, it would begin with one principle. Do not let every dollar of your life remain fully exposed to a monetary authority that has lost clean degrees of freedom. That does not mean panic. It means structure. It means shortening duration where safety is the goal. It means understanding that long promises in a trapped currency are not the same thing as true security. It means holding some assets that cannot be printed, renamed, or politically softened away. It means respecting gold not as dogma, but as a readout on institutional integrity. It means respecting that silver and miners may respond later and harder if Phase 2 becomes Phase 3. It means holding some cash, yes, but cash in instruments and structures that at least fight for you instead of sitting fully defenseless while inflation eats around the edges. It means asking every major allocation in your portfolio one brutally clear question. If the Fed must eventually solve debt and growth problems with more hidden or open money creation, do you protect me? Or do you simply stay quiet while my purchasing power, that is the adult question, and many otherwise respectable portfolios answer it very badly. This is why I do not worship the idea of a balanced portfolio in every environment. Balance is regime dependent. What balance meant in a disinflationary, debt-friendly globalization? Assisted world is not what balance means in a trapped monetary world with higher inflation risk, larger sovereign debt, and weaker natural demand for long paper. That world is gone. The old labels remain, the underlying physics changed. That is what people must update for. Now let me talk about the three phases one more time, because they are central to this whole thesis. Phase 1 is quiet and strategic. Central banks buy more gold. Institutional money positions, the public shrugs. Phase 2 is recognition. The market sees that the Fed has lost clean room. It sees that inflation and debt cannot both be handled honestly without pain too severe to be chosen politically. It begins front, running the eventual compromise. That is where we are. Phase 3 is overt surrender. The labels stop working. The printing is too obvious. The balance sheet grows too visibly. The inflationary consequences become too socially clear. That is when the crowd finally arrives, and that is when the prices that once looked eccentric begin looking inevitable. Most people only become interested in the phase they can describe at dinner. That is why they miss the phase that makes the money. The right move is not to wait for phase 3 comfort. The right move is to understand phase 2 structure. That is where asymmetry lives. This is also why I think the idea that the Fed can simply manage this neatly is one of the most dangerous fantasies in the whole market. There is no clean management here. There is only sequence management. How much inflation can be tolerated before the public revolts? How much pain can be tolerated before credit breaks? More openly, how much debt? Service pressure can be tolerated before the Treasury itself becomes the loudest political constituency in the room. How much balance sheet expansion can be hidden inside technical language before the market stops pretending the euphemisms matter? That is not control. That is choreography in a narrowing hallway. And when the hallway narrows enough, the people nearest the walls get scraped first. Those people are savers. Those people are fixed income holders. Those people are anyone who still believes nominal safety is real safety in a system beginning to finance itself more openly through monetary compromise. Now, let me give you the final image that sits behind everything I have said. Imagine the Fed standing at the center of a circular room with 4 doors. Behind one door is inflation. Behind one is recession. Behind one is sovereign funding stress. Behind one is financial instability in the private system. In a healthier era, the Fed could open one door, release a little pressure, and close it before the others burst inward. That was policy. Now every door is already pressing from the other side. Open one and the others shove harder. Close one and pressure builds elsewhere. That is not management. That is confinement. Gold is reading the room. The crowd is still listening to the speech. I know which of the two I trust more. The contract I would make with my future self in a moment. Like this is simple. I will not confuse a pause with freedom. I will not confuse a renamed money, printing operation with discipline. I will not let every unit of my savings remain fully dependent on a central bank that is now allocating bad outcomes rather than choosing good ones. I will shorten duration where safety matters. I will own some things outside the paper promise chain. I will respect gold as a measure of trapped policy, not as a noisy opinion. I will watch silver, miners, and long bonds through the lens of phase transition rather than headline reaction. And I will remember that the most important part of a monetary shift is usually visible in structure long before it is admitted in language. That is where we are now. The Fed did not merely hold. It revealed the room had gotten smaller. And once the room gets smaller, the market starts charging a different price for trust. That different price is already here. The only remaining question is how many people will wait for the official explanation after the market has already moved on.